From the way I see it, this is all the inflationary pressures, or at least a significant portion of them, are really tied to supply chain disruptions. And I think we're learning more that there's even supply chain disruptions out of Ukraine as some critical auto parts come out of that region as well, in addition to the problems in China right now. My sense is that this is going to be a process, unlike 2020, which was very much V-shaped from huge amounts of liquidity placed. This is going to be a longer, tedious process, but we're going to get through this. I would expect that markets are oversold now because of how broadened out the selling has become. And as we get, so I would expect that at least in the near term, we're probably setting up for a substantial bounce at some point of probably 5 to 7 or 8%. But then again, I'm afraid as we get further into the summer period, later into the summer, the election is going to be on a lot of people's minds. But regardless of where you sit on the political spectrum, it's change. And with change comes uncertainty. So that could be the final leg. But I would expect by then, many of the supply chain disruptions that we've had so far will begin to resolve themselves. And it gives the Federal Reserve some leeway in terms of the pace of not only the interest rate increases, but also the reduction in the Fed's balance sheet through quantitative tightening.
I said earlier in the show, maybe trying to find some kind of bright spot, because I know, listen, stocks are just another form of money. So people are losing money. It's emotional. It's a bit scary. Yeah. That there was a rationality in that the bond market was actually being bought. For most of the year, we saw bonds and stocks being sold off. First time that's happened since 1994. What do you look for, Dan, for signs of an ultimate bottom? Do we need that heavy washout 10-to-1, just awful, painful day that we, to be honest, as bad as it's been, have not yet had?
Yeah. Unfortunately, that's exactly what you need. But I am heartened a little bit. You make an excellent observation that the markets are functioning better. If you think about it, if you had a 60-40 portfolio, your 60 went down, but so did your 40 this year, which is supposed to be the ballast, the 40% you got from fixed income. You've lost money there too. The Barclays Aggregate Bond Index is down almost as much as equities are down this year, something we have rarely seen in the past. And a lot of that is just reversing a lot of the extraordinary liquidity trends that we saw over the last 18 months to 2 years.
Yeah, very quickly, you're still betting on a name like Centene. Listen, we want to buy low. For long-term investors, you want to pay less for good companies, do we not? We forget that. It's easy to forget it in a red tape like this.
Be overweight profitability. Centene's an extremely profitable managed care company. I just want to say, unfortunately, the company lost its longtime chairman and CEO, Michael Neidorff, about a month ago. I want to send condolences to his wife, Noemi, and son, Peter. But, one of his greatest legacies is the extraordinarily talented management team he left in its place. This is a $150 billion Medicaid managed care company trading at a mid-teens price earnings multiple, huge free cash flow, very, very profitable business with an improving outlook despite the economic landscape right now. Those are the kinds of companies you want to identify. The stock's flat for the year. It's outperformed massively. And I expect when markets settle down, this is going to be a big outperformer this year.